is now recording. All right, and we were back, I don't know, how far were we? 20 something?
About 20, yeah.
We did some of those. Stop it. Oh, I'm going the wrong way. No, I wasn't. Just didn't want to.
Nobody wanted it.
Okay, this is about a six. All right, this is where we were with it. Okay, so we're talking about reporting for diversified companies, and they show some nice examples in the book of that. This gets to be monster disclosure, doesn't it? Okay. So I mentioned this before. Objective of reporting segment information, provide information about different types of business activities in which an enterprise engages and different economic environments in which it operates. So you're trying to do activities and environments. So where are you doing business? What are your activities? If you think about activities, it might be by product line, right? If you think about environments, it might be locations, right? Those kinds of things. Okay, two ways you might think about it. This is going to help users better understand the enterprise's performance, better assess its prospects for future net cash flows, make more informed judgments about the enterprise as a whole by being able to look at the components. That's the idea, right? GAAP requires that general purpose financial statements include selected information on a single basis of segmentation. So, single basis, division, right, product, whatever, location. A company can meet the segment reported objective by providing financial statements segmented based on how the company's operations are managed, the management approach. Bet you anything you'll be asked about that on the CPA exam. Okay, it's kind of a hot topic, right? People are trying not to do this and still comply with FASB, right? How can I not tell people this information and still do what I'm supposed to do? How can I get around it? And when you look at segment disclosure, you're kind of like, oh, come on, give me a break, right? You are in 3 or 4 different business lines, and I can't find anything about your separate business lines. I'm really aware of this because all the time in 211 and in the MBA, I'm valuing companies, right? And I want to compare one company to another company. Wouldn't it be nice if I got a segment of the company? You're not going to find it. Okay, they're not going to give you enough. And so you get the bare minimum. And I understand why they do, right? It's proprietary information. I don't want to tell my competitors what's going on if I don't have to. I don't want you to see my financial statements. I'm a publicly held company. I put everything all together into one big pool, and you can't tell the different pieces. Of course, you're a public company that's only in that one business. You're Papa John's, right? I can tell what you do. So Pizza Hut can look at what Papa John's does, and vice versa. It's not true. Is that fair? Maybe not, right? But it's the way it is, okay? You don't have to disclose it. Well, it's supposed to kind of disclose it, at least parts of it. Okay, an operating segment is a component of an enterprise that engages in business activities from which it earns revenues and incurs expenses. Yeah. Whose operating results are regularly reviewed by the company's chief operating decision maker. What they want is how you look at the results to run the company. They want you to give that to the investing public, okay? Pretty simple, pretty straightforward, isn't it? Okay? For which discrete financial information is available. If you don't want to track separate components of your business, I guess you don't have to report them, but then how would you run your business? Do you think Young Grams knows how Pizza Hut's doing compared to KFC, compared to Taco Bell? Yeah, right? They do, don't they? Yeah. All right. It's amazing, that company. They managed to take things that could be good food and turn them into really unhealthy chunks. Right? Yeah. What's that? Watch myself. They're paying me money. Leave them alone. Yeah. They're donating money to this place too, and a whole bunch of our students go to work for them, and then I say things like that. That's okay. One of my favorite companies on earth is Brown-Forman, and they manufacture poisonous stuff, which I love, by the way. So I don't need any fat fixes. I got bourbon, right? Beer. So yeah. Anyway, that's like a doctor told me I had to get rid of cholesterol a number of years ago. My cholesterol got a little high. It's because my wife was feeding me. We were eating pasta, and she mound shrimp on top of it. So the doctor asked me what do you have with it? Oh, she put shrimp on top and all these different things. Oh, for God's sakes, can't have any shrimp anymore. I can't have oysters though still. Isn't that weird? No cholesterol on oysters. Good. When I go to Destin, I have to have oysters. Okay, anyway. Identifying your segments in a component that engages in this activity. Okay, discrete information. That's key. Oh. Okay, quantitative materiality testing. How do you determine, and we're going to have another chapter in the other book where we talk about this stuff too, so that's good, right? It's an important area. How do you identify operating segments? Quantitative materiality test. What's the rules, guys? It's nice, they pick 10%. It's a big round number, right? Okay, so you can pick it. If the revenue is 10% or more of the combined revenue of all the companies, of all the company's segments, so for the whole company, right? Put the whole company together, if you're 10%, that's the segment. So what's the maximum number of segments you could have? I guess exactly 10 if each one is 10% of your business. Got the idea? Could you have one just one business with no segments? Sure. Okay. If nothing is at least 10%, you don't have a separate segment. Got it? So you can have several, whatever. Okay, that's it. The absolute amount of its profit or loss is 10% or more of the greater in absolute amount. What do they mean by absolute amount? Profit or loss, right? So you take the absolute amount of it. If it's loss and it's big, then you're going to report it too. Okay, so must satisfy one to determine whether it's a segment. One of these. Okay, the revenue is 10% or more combined revenue. The absolute amount of its profit or loss is 10% or more of the greater in absolute amount of the combined operating profit of all operating segments that did not occur a loss, or the combined loss of all of them that did report a loss. So you add together all the losses and all the gains, and you see if this segment is 10% or more of any of them, right? If you want absolute values. Its identifiable assets are 10% or more of the combined assets. So we've got a revenue test, an income test, right? And income or loss test, and asset test. Got it? So if it's big, it's a segment. Everybody good? Okay, so then on each of them, you could have up to 10, I suppose. Identifying them, okay. In applying these tests, the company must consider two additional factors. Segmented results must equal or exceed 75% of the combined sales to unaffiliated customers. That means they're not a related party, right? Okay, they're not a subsidiary or something. For the entire company. So you got to make sure your segments get 75% of the business. That makes sense? Okay. Right? So 10% makes you a segment, 75%. When you hit 75%, it's got to be at least that much in there. Yeah.
So if you don't hit the 75%, then you can't use the segments?
No, you'll hit the 75% because one of the segments, let's say it's the main line of business, and then there's the subsidiary line of business. 85% is the main line, 15% is the subsidiary line. You'll show 85% as a segment, 15% is the segment. What they're saying is they want to make sure, even if these are small, if they go smaller than 10%, you still want to pick up 75%. So conceivably, you could go less than 10%, right? To make sure you get at least 75. Let's say they're all 9%. You'd have a mess, right? You'd have to take a bunch of them to get to the 75. How many times does 9 go into 75, right? Got the idea here? Okay, so I guess you have 9 of them, right? 9 segments. You've got the idea. To hit the 75, you got to get at least there. Because you could be in a lot of different products, you might think, right? But it's just how do you track it? By the way, is anybody ever going to get there? No, they lump stuff together and call it a segment. You don't tell people more than you have to typically, right? So you put them, some of them together to get them big enough so you can't tell, right? But, and also, how do you manage the business, right? You might be lumping them together anyway. You probably don't have 20 segments, do you? In most businesses. GE does, right? Maybe. Yeah, most businesses would. If FASB decided that 10% is a reasonable upper limit for the number of segments that a company must disclose, okay? So 75% tends the max you're going to ever hit, okay? That's enough, okay? You don't have to go more than that, okay? So 2 additional factors. Okay, and then they give an example, but I don't know if we need to spend time doing this. You list them all, right? They got the revenues, they got the profit or loss, they have the identifiable assets, and then which one are you going to pick? Anything that is what? Out of the total, more than 10%. So it's really pretty simple, right? Just compute what the percentages of the total, right? Okay, reporting segments are there for A, C, D, E, assuming these 4 segments have enough sales with all of them together to meet 75% of the combined sales. Okay, and what factor gets them there? This one does not, right? This one does, right? Jen, this one didn't, it's not 10%. This one does not. Get the idea? And then on B, why is D not one? Because it doesn't hit 10% on any of them, right? You do this? Even you? Fine. Okay. All right. 75% combined, same deal, right? All right. General information about the operating segments, what they are, what they do. Segment profit and loss related information, so you're going to give them the profit and loss for each one. The total segment assets, the same stuff that you used as the criteria. Reconciliations, what does that mean? Adds up to the whole company, right? Okay. Information about product, services, and geographic areas, and then major customers. So we're looking for that information. Okay. Yeah. It only includes unaffiliated customers and inter-segment sales, or revenue segment. Okay. Expression requires disaggregated information, products or services, geographic areas, major customers. That's how it covers that. Lovely. Okay. Interim reports cover periods of less than 1 year. Okay. So two ways you could go: discrete approach or integral approach. What do we mean by that? Each interim period, quarters, right? Each interim period stands alone, completely, like it were a separate year. What does integral mean? We're spreading estimates and amortization, depreciation, those sorts of things across all of it like it were 1 year. Does that make sense? Okay. So yeah, companies should use the same accounting principles for interim reports they use for annual reports. That would make sense. Okay. IFRS requires they use a discrete method except for tax expense, okay, which you can put across it. What do we mean by that? If we treat it as discrete or we treat it as integral. Think about taxes, just for taxes. Discrete, I actually pick up the revenues and expenses for each period. What would you do with the taxes? Well, 1 year it might look like you have a real low tax rate, or 1 quarter, I'm sorry, it might look like a real high tax rate. Another one might look like a real low tax rate. You could use the average for the year. If it's integral, right? You can estimate what the average is going to be for the year and apply it evenly across all of them, same percentage across all of them. That's not discrete, right? Discrete would be each one stands completely alone. So you have varying tax rates. So that's why they do that. Okay, makes sense. What about gains and losses on things? Should the gains and losses be across periods, or should the gains or losses all be in one discrete period? Make sense? Okay, that's all they're talking about. That's 32. Okay, unique problems. Okay, we have some interesting things. What do you do with costs that really benefit the entire year? Right? Advertising budgets. Expenses that are going to be subject to year-end adjustment, deferrals and accruals, mortgage expense, that kind of thing, right? Bad debt expense. What should you do? How should you spread that stuff? Income taxes. We don't have extraordinary items anymore, but it would apply, right? If you have a big unusual gain or loss still, right? Or both unusual. What does it apply to? Where does it go in non-operating income? Which quarter does it go in, or does it go spread across? Okay. Earnings per share issues, right? And then seasonality of the business. What do we mean? What if the business activity is really fluctuating? And you're seasonal. You have a Christmas rush.
Like retail.
Yeah, retail, selling Christmas toys and stuff, maybe, right? Okay. Things that would sell a lot at Christmas and a lot at Mother's Day. There you go. Like that. Those are our two seasons, okay, which are really big seasons, by the way, right? So you have both of those. We have two blips in our year, and the rest is down. What do you do with that seasonality? Okay, so it's kind of a smoothing issue or not really. Do we spread it across or put it all in one period? Don't make fun of me. I do not go to stores.
That's true.
That's what online is for. And I don't do that either. But stuff magically shows up in my house. We had it with my granddaughter out in Portland. We got a horseshoe ride. It's a stick coming out of this ornate head for this horse. And it plays music and stuff. And it showed up at the house just miraculously. Probably free. Right? I know that because one came and the box was bent and the thing didn't work right. My wife confessed she forgot to put the batteries in it. But maybe it was broken anyway because the box was all bent up. So they sent another. This is why it's good to do business with Nordstrom's, right? As so did we have to pay the freight both ways? And she says, of course not. She just told him, sorry, I made a mistake. He said, yeah, anyway, so, yeah. So even my wife makes mistakes, which is rare. I make lots of them. She rarely does. Okay, anyway, so we are on number 34, maybe. All right, considering the inter-financial reporting, how does the profession conclude that such reporting should be viewed? What do we want to do? Report it as though it were an integral part of the annual period. You know what? When you audit a company, you do an audit opinion on, those of you going to, some of you guys are getting real jobs, so you need to know this stuff. But anyway, so funny you got a job. You're going to do an audit opinion on the year-end financial statement. You are going to do a review on each of the quarters leading up to that. So you do 3 quarterly reviews. They are an integral part of the audit, but they're not auditing. They're doing reviews, okay? When you get to auditing class, we'll cover all that stuff. Hopefully I won't be teaching, but never know. Anyway, so yeah. So we treat these exactly the same way, right? Report is an integral part of the annual period, so that's good, okay? Okay, go ahead and read the opinion. I used to make students memorize this. It was a slight bit shorter, and now there's one for the independent auditors, and there's on the financial statements. There's another one for independent auditors on their internal controls, and then there's one from the management. They do one too, and all 3 are required. So I don't make anybody memorize them anymore, but here's the suggestion for you. Before you do the CPA exam, memorize that puppy. And then when they ask you questions about it, you can answer any question. They won't ask you to write one out, but it's still a really good idea. It's just got a little bit long. I wouldn't memorize all of them, okay? But this is called a clean, unqualified opinion, okay? This is the unqualified one. You can also do adverse opinions, you can do disclaimers, and you can do qualified opinions. And the qualifications are for either a scope limitation, which means they wouldn't let you collect all the evidence you needed to. Either the client imposes the scope on you, which, by the way, if they do that with me, I want to disclaim. It stopped the audit. Or maybe they lost some records burned up, the computer system failed, it's not practical to get all the information, right? You might have a qualification, right, for a scope limitation, scope of the audit limitation. The other type of qualification, and if you really can't do the audit because you can't collect enough evidence, that's a disclaimer. And I know this is really kind of quick and dirty, but we're going to do it in auditing a lot. But read this and take it seriously. It'll help you when you get into the auditing class, 418. And the auditing class is 1/4 of the CPA exam, right, guys? Now, one class is one part of the CPA exam. So this is going to be big, right? So anything you can get before that, great. And you've looked at this a little bit before, earlier in here, and maybe in 101, but they're trying to show you more now, okay? So anyway, so what you do is you either give a clean opinion, unqualified. By the way, for any publicly held company, it must be a clean opinion or they are delisted. What do I mean by that? They cannot sell their stock. It's over. They're not on the American Stock Exchange. They're not on the New York Stock Exchange. They're not on international stock exchanges anymore.
When does that,
They're
why
done.
does that happen?
That happens if you do not follow generally accepted accounting principles, or there's a scope limitation that prevents them from giving you a clean opinion. So do you want clean opinions in a publicly held company? Yes. You'll always want them, but boy do they want them then, right? Okay, so you won't see any qualified opinions in public companies. Well, you will, but they've been delisted. They're in big trouble, right? They have a really big problem, okay? But almost never, of course. So the CPA firms are going to make sure that the client does everything right, and the client's going to make sure, the company is going to make sure they do everything right, so they don't end up in that boat. It doesn't mean there's not still a lot of work going on, and a lot of negotiation going on, right? There's lots of auditing going on, but we are going to try to give clean opinions, right? Unqualified opinions. You're not supposed to call them clean, by the way. On the CPA exam, do not use that word, even though everybody calls them that. When you go to work, they're going to say, was it a clean opinion or not, right? You know, where are we at on this thing? It's unqualified. It's unqualified. It's unqualified. It's unqualified. Everybody got that? So get that ingrained in your brain. I shouldn't do that, should I? Tell you, jargon. Although, have you heard that phrase? Those of you who've been working out there on audits with firms, anybody say clean versus unqualified? They're probably don't have you in those discussions yet, right? Of whether or not it's going to be an unqualified opinion. Okay. Anyway, if it's a scope limitation, you couldn't do all the auditing because it talks about what you did when you audited here, right? You collected evidence and all that. Read it and think about it. Okay. Oh, by the way, we don't vary this thing. We say exactly that. You know, the firm name will change, the city will change, and the date will change, you know, and the company will change, right? Nothing else. Every single word is the same. Why? We don't want there to be any confusion. It's not that accountants are boring, we probably are, but what we're trying to do is what? Convey exactly what we mean. So you need to know this thing. That's why I like the idea of memorizing it, right? They're going to test you on it a lot in the auditing section of the exam. What's going on here is we are telling people exactly what an audit is and exactly what it is not. We collect evidence. Is there somebody standing next to every kid at McDonald's that's punching Big Mac, making sure they do it right? No. Then how do we know that every time they push the right button? We don't. But we do samples of every single transaction. They've got 1 million sales, right? Or lots more at McDonald's, right? We do a little tiny sample. We'll look at 100 of them. And then we're going to use statistics, right? A random, statistically valid random sample. We're going to look at 100 maybe, right? And we're going to extend that results to the millions of transactions that were there. And we're going to draw conclusions about how good a job they're doing recording all of those. Our opinion is based on a little tiny collection of evidence. Okay? Yeah, right? So we say in our opinion. Well, no kidding. We don't know, right? In our opinion, based on our audit and based on the evidence we collected and all that, you know, everything's fine. Everything's hunky-dory. The financial statements fairly present the financial position of the company, the results of their operations, and their cash flows for the period ended, right? And we show 2 balance sheets, and we show 3 income statements, and 3 cash flow statements. You get an opinion on all that stuff. Got it? Okay, so this is serious stuff, so take a really good look at this. By the way, the person who signs this is the partner on the engagement, right? Nobody else gets to sign it. You don't sign your own name, you sign your firm's name, okay? Unless you're a one-person shop, but you're the firm, okay? And then you got the date there, and this is the date, the May 1st down there, is the date that they finished the audit, right? In the field work, the date they stopped collecting evidence, not the date they delivered the statements. That'll be sometime later. But that's the date we're taking responsibility for. So when we talk about subsequent events, if the year end is December, when is the year end? March 3rd and February 26th is the year end, and they're delivering it May 1st, what about the period between those? That's when subsequent events can happen, right? That's a period of time, sure, after the year end. Okay, anyway, so if we have a scope limitation, we might qualify for that, right? If it's material enough. Oh, by the way, if it's an immaterial scope limitation, what do you suppose you do? Nothing, it's immaterial. Give the unqualified opinion. What if it's material but it does not overshadow the usefulness of the statements as a whole? What do, gang? We qualify for it. You can rely on it, but not in this area, because we didn't do this area. Got it? What if it's so big, there's several of them, or it's client imposed? In my case, the client won't let me look at stuff. I don't know about you, but I really want to look at something somebody won't let me see. I hope you've got that in you, right? Don't tell me I can't do it. When I was a little kid, if you told me I couldn't do something, that was an invitation to do it. It must be fun, or an adult wouldn't say don't do it, right? It's dangerous. You run into the street and stuff, right? You know, see what happens when a car hits you. Yeah, so, you know, you don't get carried away with this, but I want to look at everything, right, that they don't want me to see. Usually that's a big mess if they don't want you to see it. And I could use some horror stories on it. But, you know, amazing things that people don't want you to look at. And you go look at it and think, wow, you know, their income just disappeared, right? Looking at one thing. So anyway, if they won't let me look at it, I'm probably going all the way to disclaimer. What does the disclaimer say? I couldn't do it on it. And I'm not let's give an opinion. Couldn't do it, right? Couldn't do the audit. Okay, now the other one's gap violation. What do I mean? They are not following generally accepted accounting principles. What if the gap violation is immaterial? Everybody knows you have to follow allowance for doubtful accounts. Got to use it, right? That's the method, right? For bad debt expense, you have to use the allowance method, right? Okay, what if they're doing direct write-off with the impact is immaterial? Who cares? That's not a violation of gap because it's immaterial, right? It's only a violation of gap if it's material. So if that were the case, I'd still give an unqualified opinion, wouldn't you? What though if they're not using the allowance method? It's stupid, what not to do, but they're not doing the allowance method, but it's material enough that somebody should be concerned about it, but it doesn't overshadow the usefulness of the statements. What would I do? I would qualify for that, so I'd have a qualification for a gap violation. Got it? 2 types of qualifications, okay? And then what? What if the gap violation is so big that you really can't rely on those numbers? there's several gap violations, right? You add them up and the total is so material, you really shouldn't rely on the statements. Then we give a what? Adverse opinion. I've only seen a few adverse opinions in my career, and those were where a union was required to have an audit done, and they refused to issue the information in the financial statements, the union organization. Their bylaws, they had to have it. Management of the union says, I don't care if it's qualified or not. I don't care if it's adverse or not. We gave adverse opinions and collected a fee, right? Stupid, right? But typically what will happen, you're gonna give somebody an adverse opinion and you get banged for them. No, you're not. They're either going to fix the statements so they're in compliance with GAAP, or they're gonna fire you and find somebody that will do what they wanted to do. Don't be that other CPA firm that will do what somebody wants them to do when it's violating GAAP. By the way, could the two of you be working in two different firms and you have different, legitimate, different opinions about what GAAP is? Yes. About what materiality is? Yes. But be careful. Now we have rules where if a new auditor takes over, they have to have contact with the prior auditor, and they both have to talk to each other, and they have to talk about any open issues like that. So if you want to go out, you're the client, and you want to shop between the two of them, you're fighting with him about GAAP. If you want to go to him, they have to talk to each other. You're dead meat, right? They're going to talk about what the GAAP violation is, and they're both going to say, hey, that's a GAAP violation. Yeah.
Can you bill for that time like you did previously?
Well, you can bill for anything you want. If you're getting fired, I doubt if you're going to get paid. Yeah, there's risk in our business too. Yeah, that's a good point. But yeah, I bill for this, I'm sure, but they'd probably not pay me after they fired me.
I'm just thinking though, if it takes up.
Oh yeah, the client knows that too. You really want to do this? You really want to bring in other CPAs? And they might. No, let's bring in another firm and let's see what they think. That's fine. You know, so you're with a firm, he's with a firm, and you guys are gonna, you know, you could get together and talk about what you think GAAP is. And the client could get both of your viewpoints. But you both know what each other's viewpoint is now. They can't go and shop for principles anymore. It's cool. I think that's a good move forward. Okay, so stop doing that. Anyway, enough on that. I did turn into an audit class, sorry. Okay, all right, so. All right, anyway, so, and then other things, you need explanatory paragraph if they're not a going concern. Hey, guys, that's not a qualification, that's an explanatory paragraph. In an explanatory paragraph, you can make an unqualified opinion, and then you say in an explanatory paragraph, oh, by the way, I don't think they're gonna survive another year. That used to be a subject to survival thing, subject to going concern qualification. For some reason, we thought that was misleading. This isn't. The opinion's fine, but they might not make it another year. So if you're not gonna put, by the way, what if you put that in there? You think people notice? You own the stock, you're an outside shareholder, and you're not running the company, and I tell you, oh, by the way, I don't think they're gonna make it another year. You think you might take action on that one? Yeah, so of course the bottom falls out of the stock price if you do that. And again, public companies couldn't have that. Okay, but yeah, you do that. It's just an emphasis of the matter, really. Lack of consistency. I followed GAAP before, I followed GAAP now, it's a different GAAP. So I'll put a comment, right? One line that says that the statements aren't consistent. And I'll refer to the note in the financial statements where they describe that. Because we would have a note, right, in this chapter. If you're not consistent period to period, right, you'll have a note describing it in full detail. What's the impact on the statements, okay? But you switch from FIFO to LIFO or something, that sort of thing. Or there's a new FASB, and so you switch because of that, right? Okay, emphasis of matter could be anything you want. I have never seen anybody do this. Is one thing more important than anything else in the financial statements? You could emphasize that in your audit. I don't know what that is. Just do it in the notes in the financial statements, disclose everything properly is what I would do. But you can if you want. You can emphasize it in the auditor's report at a particular matter. You have to do the going concern if you have that situation. By the way, how do you keep it from being a going concern? I've actually done this. It's terrible. It's 1 year. I've had a couple of engagements when I was in a small firm, Dwyer, Curran, Colson, where we waited for the year to go by before we issued their statements. Because we didn't know if they'd make it a year, but then they had. So we issued the statements and did not mention whether they were going to make it for a year or not. That's a dire situation, isn't it? But the banker, of course, knew these were small companies. The banker knew that we didn't issue the statements for a full year. They knew what we were doing. But there was a requirement in their debt covenant that they had to have a statement issued, or all the debt was 100% due, right? So we did it. It was okay. But they made it a year. They made it a year. Do we know they were going to make it another year? Of course not. We weren't talking about that year. We were only talking about the year from when the financial statement date. Full year late. Don't do that stuff. But yeah, so Going concern's a real issue, sure. All right, anyway, I talked about that, okay. Disclosures are assumed to be adequate, right? All right, so, yeah, this disclosure is really interesting. Do you guys think that after this week, do you think the stock market's pretty efficient or what? It's going pretty good, right? 3 to 4% of the U.S. economy is selling things and buying things from Great Britain. And our stock market just went down by what, 1,000 points? What did it do today? But have some more?
Yeah, I went down like 50.
Okay, so we've lost about 1,000 out of 18,000, something like that. Over 3 to 4% of our economy. Which is, of course, even if they closed Great Britain, all that economy would move to someplace else. Rational market, right? Anybody have 100,000 sitting around that they don't have invested somewhere? Good time now. It's going to go right back up, of course, right? There's no reason for it to have gone down. What's the reason? We don't know what's next. Uncertainty. People are nervous, right? So people were gambling on whether or not this was going to go through, and as soon as it hit, the prices were still high. People started selling, betting on it's going to go down, and then they're going to go back in. Don't do that with your 401k. You might guess wrong. Lots of times I thought the market was overvalued, and I thought, God, geez, should get out, wait for it to go down and get back in. I resisted the temptation, and it kept going up and up and up and up. And it's more and more ridiculous. And then all of a sudden, in a couple month period, what happened? Went to 50%. Is it going to go to 50% this time? God, I hope not. How stupid would that be? But if it does, I guess, you know what? When the market goes down, we buy cheap. Stocks are probably undervalued now. Good time to buy, so keep investing. When they're too high, what do? You have to keep investing because they might be running going up. And you're not going to do as well anywhere else anyway. So people are taking money out and putting it all kinds of crazy places and driving up the price of other things. Real estate will go nuts, right? The bond market has gone crazy. Interest rates on bonds are going way down. Why? Because people are moving their money into the bond market and raising the cost of the bond, and the interest rates stay constant, right, guys? You know this. So what happens? They drive up the price of the bond, so the effective interest rate is going down. So that's a great investment. Let's put it in something that, you know, is going up in value and buying high in the bond market, getting out of the stock market that's now low, probably crazy, right? Leave it alone. Don't go with the lemmings. Don't be one of them. So anyway, you'll do far better. So, but you never know. We may elect Trump and then think of what will happen to the worldwide economy. Who knows, right? It'd probably be good news. I don't know. So, you never know. I can't believe how many Republicans now are deciding, nah, we'll just give this election away. Like, scared. I mean, the top ones, the Senate, the House, and stuff. They're worried about their future. Okay, this management report. By the way, I mentioned to you last time that we don't audit this thing, but we read it, right? It's going to be with the financial statements, so we read it. So the SEC mandates this. This is all for publicly held companies, right? Small companies do not have to do this, of course, right? If you're privately held. Management highlights favorable and unfavorable trends related to liquidity, capital resources, results of operations, identify significant events and uncertainties. Now, there can be a management letter separate from the management discussion and analysis. Management discussion and analysis, they try to be as factual as they can. But they're talking about uncertainty in the futures, risk, things that are happening in the business, what their plans are. So it's not historical, factual information, right? Still their opinion to some extent. But they try not to get carried away. Good management tries not to get carried away here. They just try to lay it out there. In the management letter, they'll talk about all their glorious plans and how wonderful it's going to work. We don't care about the management letter, right? We're not affiliated with that. We're not associated with it. We do care about this, okay? So we'll read this, and if they lie in it, right, we get them to rewrite it, okay? So, by the way, do auditors have quite a bit of power here? I mean, they're paying you. So do they own you because they're paying you? Let's hope not. Let's hope you're really independent, right? Who do you work for? Hey, you guys, I do not work for Bellarmine University. I work for you. I'm a professional. And that comes from being in public accounting. I did not work for my clients. I work for everybody who would ever look at those financial statements. My client just happened to be paying the bill. It doesn't matter. In this case, it's even worse. You're paying the bill, so of course I work for you, right? A big chunk of it is coming from you guys, not the majority, right? There's all kinds of other funding, of course, but I'm working for you, and I'm aware of that, right? I don't work for Bellarmine. Bellarmine's just an institution. It's the group of us together. You guys and I are Bellarmine, and everybody who works here is Bellarmine, right? Okay? Corporations are the same thing. It's just a bunch of people together doing stuff, right? Keep that in mind. Corporations don't really exist. I know the Supreme Court says they do, but they don't really, right? They're us, right? So, who are you loyal to? Who are you loyal to? I hope you're professional, right? I hope you're professional. Did I tell you guys when Arthur Anderson folded here in Louisville? I mentioned this to you? The managing partner, Pat Cass, at Arthur Anderson's office. Where did he end up when it collapsed? EY took over Louisville's practice for Arthur Anderson. Different cities went to different firms, right? But they pretty much absorbed it and brought in most of their clients. Not all of them, some of them switched to different firms, right? But they brought in most of their clients when Arthur failed, right? Guess what Pat Cass became? Managing partner of the combined firm, now called EY. He moved from being managing partner at Arthur Anderson to managing partner at EY. The current managing partner at EY got demoted. Arthur was a bigger office in this town than EY was, much bigger. Oh, they did more hiring here than EY did in those days. Well, why is EY so big now? Because they absorbed Arthur Anderson and had their own too, and now they were really big, right? At Bellarmine, okay? That's how we ended up with 75% of their people or something in Bellarmine once, right? Put those two together. Arthur Anderson even more percentage-wise at that time. Dave Cowsey, he was the head of audit practice at Arthur Anderson. What did he immediately become? The head of audit practice at EY. Pissed off some people at EY, by the way. Right? That's what they did, right? So why were they able to do that when they were with a firm that failed? They didn't really work for that firm. They worked for the profession. They maintained their integrity. Do you think everybody that was a partner at Arthur Anderson was a crook? No. I think the guy that was running the audit on Arthur, or rather on WorldCom was. I think the one on Enron was. But I think there were partners who were crooks in other CPA firms too, who were letting things go that they really shouldn't have and were lining their own pockets. Accountants are stupid. We don't ever get a bribe. We just get our fees and we get our career and all that stuff. The guy, Dave Cowsey, told me he saw the guy from, I can't remember his name now. Was it Duncan? David Duncan. For some reason that's in my head. But anyway, he was the managing partner in engagement. He was a young partner and he was doing really, really well in the firm. Dave got brought in. They have, you guys know who Dave Cowsey is, right? Managing partner anyway, they have partners in the U.S. and then they have worldwide partners. And then when you make worldwide partner, you really made it. Now you're making real money. And so he became a worldwide partner. The year he became a worldwide partner, guess what? The Enron fiasco hit. And right before that, he had gone to the meeting of all the worldwide partners all over the world, right? And they're there. And this guy was the keynote speaker. He got up there and he talked about all the wonderful things they were doing at Enron and the new way that we do audits and the new way that everything works in the public accounting profession. And then a few months later, Arthur Anderson did not exist. Oh, wow. He was a superstar. So he wasn't taking bribes, probably. He didn't make millions off of it. What did he get? To be the managing partner on an engagement that was one of the largest ones in the world. This was one of the largest companies in the world. Be careful, you guys. Be careful. He ended up in jail too, but yeah, for a while, and lost an awful lot of money. So he did get punished a little for his stupidity. But anyway, and he probably convinced himself that all of it wasn't material and all of it made sense and all of it really was in conformity with GAAP. And he probably convinced himself he didn't really know and that they'd really done a good audit. Probably did. He probably believed he had. Human beings, what's in that frog triangle? Incentive. What's your incentive? His was not to get rich. He had plenty of money already. He was a really young partner, right? He's already wealthy. And it was for fame, not for glory, right? For building his career. So the incentive is there. The opportunity is there, right, guys? And what else? Incentive, the opportunity. What else? in that fraud tracker? You guys are supposed to know. You're motivated to steal, right? And you send this in, and you want something, right? Obviously, I have a price too. If one of my grandkids had a terminal disease, but it could be cured if you had enough money, I'd steal all the money you needed to. Hell yes, no problem. I could rationalize that easy. Oh, that's the piece. You have the opportunity, you have the incentive, and you have the ability to rationalize your behavior. That's the big one. Can you rationalize doing something that's really unethical? Can you rationalize, I know that disclosure is not really full disclosure, but the client really doesn't want full disclosure, and they're going to fire us if we press the issue. What do you have to be willing to do? Get fired. Could you rationalize yourself with it and say, well, it's not that material. It's not that big. You have this pressure on you, right? Okay. I have been fired by clients, and I have fired clients both over issues of integrity, basically, right? Okay, and it's painful. At Dwyer, Pimmer, and Colson, we fired our third largest client because we realized they were a bunch of crooks. Didn't want anything to do with it. And it hurt, right? Didn't hire staff for a year, right? The partners made a lot less money. Nobody got raises. Yeah.
So when you went to prison,
When I went to prison?
no, when
Oh.
the guy we were just talking about, the auditor,
I spent a day in jail once, but that's a whole different story.
Oh.
It was just a night. It wasn't the whole, it wasn't a day. It was just a.
what happened to all of his earnings? Do they turn it over to the company? Like, I was
There are fines, and usually if you steal $100 million, they make you pay a $10 million fine. You know that, right? But with all this new stuff with Sarbanes-Oxley, there's getting to be teeth in the law, isn't there? People actually get to go to jail now for their frauds. Oh, that management letter that they have to do, there's the auditor's opinion on internal controls and on the financial statements. The CEO and the CFO both sign that they agree with all these representations. They can go to jail too now in public companies. All of a sudden, they cared a lot more about the disclosures and about the audit, because now they get to go to jail too if things are screwed up, not just the auditors. Okay? Obviously, you guys want to leave, and I didn't get through most of the chapters. It's terrible. Is it time? No, it's not. Why are you putting stuff away? Is it somebody leaving? We have until 4 till that one. You can't leave. Good, we'll get through some of it. Okay, anything. I don't know why. I guess it's because I have 5 hours in a row. 10 a.m. to 3 p.m. It just can't be this long. I'm too old to stand up here. Yeah, this long. That's what it is. I used to get more and more pumped up and louder as time went on. Now, by the time I have you guys, I'm just sliding to the floor. Sorry about that. I was supposed to have an auditing class this summer too. Did you know that? I really was. Poor David Collins thought that we were going to have. There was a student who needed auditing to graduate, and I said, okay, fine. I guess I'll do it as an independent study. And then we looked around and we found 3 other people that really would have liked to have taken it. So we're going to do the class with 4, right? And so I was going to have 4 people sitting here and do auditing within the summer. And I did the syllabus and everything. And so then I sent out emails to the 4 of them telling them everything's ready to go. And the one that really needed it sent me back an email and says, Keith, I saw you at graduation. I'm done. And well, yeah, but I thought you just got a special dispensation to walk because you're the reason we're doing this class. Because you go permission to walk, you're graduating song. And she said, no, I'm done. I'm completely done. So I canceled the class. Thank goodness. I'd be here till 5 or something doing that thing. So anyway, all right. Auditing's kind of fun. Okay, anyway. So what's this thing? This is Pepsi's management discussion analysis. I'd read through these. Read one, okay? Read this one. Read a real one for somebody. Read a management discussion analysis sometime before you graduate. Not necessarily for this class. But take a look at that and see what's in there. What kind of things do they say? How do they present things? They're talking about their risks. They're talking about how their business is set up. This is the risk management framework, for instance, and what the market risks are for Pepsi, right? There's a lot of good information in those. So, and again, in the management discussion analysis, they are trying to tell the truth to the extent they know it, right? Because they know the SEC is reading this, and they're in big trouble if they don't tell the truth. Does that make sense? And so we kind of help them with that. We read it, and by the way, Does management have a bias? We're independent, which I hope you really are. We're totally independent. What about management? Of course they're not independent. They want the company to do well. You will run across, particularly with smaller clients, when I was with a small firm, you wouldn't believe how many people think financial statements are an advertisement. They don't say that. But you know, if these statements look better, we are going to get more financing. We're going to get a lower interest rate. We're going to sell our stock for a higher price. Your job, CPA, is to help us look as good as possible. And what do you have to say? No, my job is to help you tell the truth. What? I'm paying you? I don't need you to help me tell the truth. I need you to help me get my stock issued. I need you to help me get a loan. No. We're doing an audit. We're doing a review. We're doing a compilation. Even the lowest level of service. We're just going to tell the truth. The argument you should use to get management to tell the truth, whether you're working inside the company as a controller or something, right? Financial vice president, or you're the outside CPA. The argument you should use is lying is extremely expensive. First, when you say the word lying, you say, I don't want to lie. I just want to make it look better, right? Well, anyway, so if you're not transparent, if you don't tell the truth, if you have done this with you guys, all of you guys I know, if somebody you give somebody your money, and they lie to you about what they do with it, what do you want? Your money back. And that works so well. With presidents of the company, you just say that. If we aren't transparent about these transactions, if we don't really tell them what's going on, if we don't really have full disclosure, we don't tell them what they should know and what they are entitled to know, if we don't, later when they find out, they're not just going to be mad about this, they're not going to believe anything we've ever said or anything we say in the future. We're dead. It's over. When your reputation's gone, it's gone. You don't get it back. That's the thing that amazes me with all these frauds where CPA firms did a horrible job. They destroyed themselves. What are we charging people for? Our signature on a piece of paper. It's a black box to the client. You go out to the client. You cannot tell them what you do. You can't, by definition, you can't tell them what evidence you're collecting. You can't tell them what you're looking for. You can't tell them anything. So it's this black box type thing. They hire you, they give you a whole bunch of money, you give them a piece of paper with your signature on it, attached to their financial statements, and you leave. And they never know what you did. Do they know whether or not you collected adequate evidence? Of course not. You do. You're not going to show them the evidence you collected. There's no, that doesn't happen. And it can't happen. What if they know what you're looking for, and then you go start trying to collect evidence? Right? It's not going to work, by the way. I always, when I was teaching auditing all the time, which I did forever, until a couple of years ago, my entire career, I'd bring in CPAs, and it was interesting to watch how, partnership firms, it's interesting to watch how things evolve. Right before each scandal, it's every 10 to 15 years, there's big scandals go on. I think I mentioned that to you before. Every 10 or 15 years, things go crazy, right? Watch for those cycles. And all kinds of frauds in our economy, people ripping people off, and then another 10 or 15. But we get real serious for a while, we watch, and CPAs tend to do the same thing. I actually had, and this was Dave Cowsey came in, and this was when Arthur Anderson was still around, and he says, well, we do auditing different now, Keith. In our risk assessment on the audit, we get the management of the company together, and we get the auditors together, and we all talk about what the risk areas are, and where we should emphasize auditing and all that sort of thing. Which, by the way, sounds really good, and it is a good thing. And I says, yeah, but you really have the client establish your scopes for materiality in different areas, right, when you're doing your audit, how material an item would be when you look at it. You talk to the client about that, and what the risk areas are in the business of the client. I think asking the client what they think the risk areas are is a really good idea, but I think you should determine what the risk areas are in your audit. And by the way, guess what happened after all the scandals and the Sarbanes-Oxley thing came out as a result of it? All the companies went down. Guess what happened? We rolled the clock back, and all that got separated again. Clients do not determine what you audit, you determine what you audit. It's a black box for them, okay? So imagine paying a couple $1 million to some firm for their signature. You ought to be able to trust that signature, right, guys? So this is serious stuff, okay? And it's a big part of what we provide to the public. Protecting the investing public, I suppose. Okay, anyway, so what do they have in there that we already talked about? Okay, Sarbanes-Oxley, we beat that to death. That's a senator's name and a representative's name. Act of Congress, right guys? Okay. This created, by the way, tremendous amount of work for CPA firms. It just went crazy. Everybody, the economy was collapsing, right? And then all of a sudden, for us, it was going crazy. Every time there were big scandals, we had lots of work. We did everybody's internal controls in every single company, every major company in the world, as a result of Sarbanes-Oxley. Amazing amount of work designing internal controls. So here's what the deal was. One big four CPA firm would be your auditor. Another big four CPA firm was your consultant to do all your internal controls. Because the auditor had to audit the internal controls after they were established. So one did that. And then another CPA firm would be your tax accountants, right? Doing your tax returns. It's nice to keep that separate too. You don't have to, but it's nice to keep that separate too. So they'd have three of the big four. And then the fourth one was going to be their next auditor. And they just roll. And that's kind of the way it works. One's your consultant, one's your tax accountant, one's your auditor, if you're a big company, right? And the fourth one is waiting in the wings because they're independent by definition. They'll be your next auditor. And you roll one off. And that's what goes on, right? Kind of how it works. There's only four firms left. Do you think that the government is going to allow one of the big four CPA firms to fail? Nope. We only have three. What a mess. We are in a mess. It was far better when there were a lot more, right? You know, competition-wise. Well, we're not very good at competing either. Several partners have mentioned that to me too. One of the reasons we think these frauds happen is that we compete on price on audits. So we try to get the price lower and lower and lower. And then we do less and less work because we think we're more and more efficient. Anybody worked in an environment where you're supposed to do more with less? Everybody has, right? Yeah, well, you can keep downsizing until you don't exist, right? That's the ultimate downsizing. You just fire everybody and go home, right? So you want to do intelligent, right, reduction of costs. I want revenues too. I don't just want to reduce my costs. I want revenues to go up. Are you guys? Yeah. So don't get rid of cost. If the revenues exceed the cost for something, should you get rid of that cost? No, get rid of costs that aren't generating any revenues. But anyway, what CPA firms did was they wanted to get the fees down and down and down. And the reason they were doing this is they wanted to get the client so they could do consulting work for them because you made a lot of money in the consulting work, right? And we get into this cycle over and over and over. Well, in last couple of years, I've had a number of partners in big four firms say we are now competing heavily on price again. And I'm nervous because we're getting more and more pressure to get the costs down. And of course, you can do that with more technology, right? You know, if you have more ability to communicate via television or something, right, via this stuff, obviously you do a better audit, right? Well, maybe not, right? Make sure you're really collecting the evidence you need to do the job. Now, should we collect any evidence that is not necessary? Of course not. You're stealing the fee from the client. It's your judgment how much evidence you need, right? So if you are collecting evidence that's not necessary, don't do it. Don't bill them as much. I'm fine with that. Okay?
So do you leave it off and you collect it and you found out for some reason this is actually immaterial or unnecessary?
Well, you still bill them if they knew that was the normal plan and you knew it was the normal plan, and then the next time you wouldn't do that. You'd do a little bit different. You'd learn from it. You know, maybe on different engagements, but on that engagement in particular. You know, you thought their internal controls weren't very good. You find that they really were. Well, you probably collected too much evidence, right? But so then in the future you check the internal controls a little more carefully, that kind of thing. Yeah, good questions. Okay. Anyway, yeah, Home Depot's report of management responsibilities. Read one of those. And projections and forecasts. We can actually do reports on financial forecast and projections. What's the deal with the forecast? It is your what? Best estimate of what's going to happen in the future. It's an estimate of the future, okay? And then financial projections are one or more hypothetical assumptions. So maybe best case, worst case, and something in between, right? Really useful. So as many different projections as you want. This is really useful. If you're thinking about launching a new product line, here's the best that could turn out, here's the worst that could turn out. It's really good to look at the worst. And here's what I expect to happen in between. I like 3. You can do 5 if you want, right? Best case, worst case, mediocre on both sides, and what you really expect to happen, right? That kind of thing. So it gives people sort of a sensitivity analysis with that, but that's it. And we can actually do work on these as outside independent accountants, right? Okay? Not really an audit because it's the future. Project the future. Okay. All right. And so they're kind of fun. Fun to work on. Okay, so yeah, forecast. Internet financial reporting. This is kind of cool. Have you ever seen those little symbols when you're buying something online that says it is audited? Can't remember something check. That's our profession doing that stuff. We do it on services. A lot of stuff for seniors. We do work. We go make sure that the company like Atria does a good job. They're providing services to our parents, our grandparents, right? We make sure that, and we're maybe paying for it too, right? We make sure they're doing a good job. Or we're responsible for our parents now and they're paying for it themselves, but we want to make sure they're getting bargain for their money and they're getting really good care. You live in New York City, they live in LA, got it? Or Louisville, and it can be Memphis, no matter. You're not there all the time, right? And so they watch for you, right? And the profession's taking on a lot of that stuff. So this works good. This allows people to do business via the internet. It's a big issue for us, isn't it? Are people, going into stealing data, credit card numbers and all this stuff? Yeah. So we're in the middle of this stuff. Okay. So of course, right? So we try to make sure that they're not vulnerable. And so, international financial reporting standards like to put things in different orders, don't they? Right? Than we do. And it's okay. They separate their balance sheet, statement of financial position, into operating versus investing. It sounds more like a cash flow statement. And then business activities, and then financing, and then the taxes. Comprehensive income it looks different too, doesn't it? Okay. Statement of cash flows, kind of the same. Okay. Right? But different order, a little bit different order. Okay. So I think their balance sheet and their income statement look an awful lot alike, except one's cash basis and one's accrual, and maybe that's good. More comparable between the two statements. I don't know. So, and we're converging with them, so everybody's going to be doing it the same way. Okay, so by the way, one thing you can count on throughout your career is things will change. What do we try to do in your education here for a couple years? Hold the world constant, right? They changed that damn extraordinary act, they did, right? But hold the world constant. It's not really staying constant, it's gradually falling. Over the course of your career, things will change a lot. And that's good, You know what's really fun? I knew several people who built their career on price controls. You guys ever hear about price controls back before Jimmy Carter's administration? He wasn't a terrible president. He was a good guy, good at history, fine. But he just made one really dumb thing. He tried to institute price controls because inflation was out of control. And he put price controls in the economy so you weren't able to raise your price only a certain amount. It's like government control prices. It does not work. Competitive markets work so much better. And then it's just crazy. Sometimes competitive markets are real painful. When gasoline goes $5 a gallon, it's painful, but we don't really want to tell them they can't raise the price of the gas because we kind of like to have some gas. And if you tell them they can't raise the price and their cost goes up dramatically, you're dead, right? And you've got it. So anyway, but he put those in. What I was going to say is I knew several people who made their careers by understanding the law and implementing the law, and they were experts, right, in price controls. And then guess what the government did suddenly? They went away. And they built their career on this in a few years. And they made senior, manager, partner. Got the idea? It was still okay because they made senior, manager, or partner. And then guess what they did? Learn something else. Go another direction. It's okay because they got to go in really fast. A number of years ago, like maybe 10 years now, between now and then, right, back to about 10 years, a whole bunch of people became experts in international financial reporting standards. And I thought, that's really cool. And they're traveling around the world, they're having a really good time, and they're billing people a lot of money because they know US GAAP and they know IFRS. But then what have we done? We put them together into one thing. Is it going to be valuable to know US GAAP, international financial reporting standards? In fact, it's not very valuable now. Why? Because they're pretty much the same thing. So that expertise went away. It's all right, it doesn't matter. New FASB comes out, you can become expert at it and do well in your career by being expert at it. And then it'll be superseded by something else later, okay? Or at the very least, everybody will know it anyway, so you knowing it is no big deal. But if you're the first one there, good deal, huh? Do that in business too. If you're the first one with a new product, it's gold, right? For a while. Until everybody else does it too, and then we call them first movers, right? You can make a lot of money that way. Of course, you have to guess which product people are going to buy. You're the first mover on one that wins, not the first mover on one that turns out to be a dog, right? Bottom falls out. So that's the game. We're watching the people in executive MBA, they're all trying to do that. They're all trying to do it. We actually have a project that they do in the MBA in general, but in executive MBA it's real interesting because they have more expertise, more, more years of experience, more education stuff. They come up with a business plan, and some of them end up being real. But we've had people in the weekend, some of you guys are going to do the weeknight MBA, right? I didn't do it yesterday. Try to get it today. Anyway, they're going to let you. We got at least a 2.0, right? Yeah. Okay, anyway, so, yeah. I'm supposed to write a letter or actually check a bunch of squares and say that you're glorious. So I'll give you at least average. So, okay, anyway. So. It's fun. You have to fill those out. What I really should be able to do is send an email to the MBA office that says, for God's sakes, let them in. Right? Much like county makers, for God's sakes, let them in. They're going to let you in anyway. But we have to have 2 letters of recommendation in the file for when ACSB comes here, so they can see that we have 2 letters of recommendation in the file. So anyway, fraudulent stuff, we've talked about that a bit. Intentional or reckless conduct, yeah, all that stuff. This is kind of cool. What really is the big thing that happens? What kind of things are there? Survey, how many are there in 3,000 companies? This asset misappropriation, somebody stole some money, is bigger than the accounting fraud. Which one's the money, though? Which one's the money? It flip-flops, doesn't it? The frauds are what really cost money, not asset misappropriation. Stealing a little bit of money out of the cash register, it's not a very big deal, right? That kind of thing isn't going to hit you. That accounting fraud is going to be big. So that's kind of interesting. So take a look at that stuff. Okay. Wide range of stuff that goes on for the different years. Yeah, there's a lot of these out there. Be aware that they're out there. Common causes for fraudulent financial reporting: get the stock price up. When I issue stock, I get more money. If I have stock options, when I sell my stock options, I get more money. Either way, right? So personal interest, company interest, avoid default on a loan covenant. If you violate a loan covenant, you have a current ratio down. Can't be worse than 1 to 1, right? Can't be lower than 1 to 1. Okay, or 1.5 to 1%. Might be cheat and classify a non-current asset as a current asset, or a non-current, or a current liability as a non-current liability. Get your current ratio up. Sure, you can do that, no problem, huh? Right? Easy to do, really simple. What happens if you violate one of those loan covenants? The entire 100% of that is due right now. Might you be tempted to do that? Sure. Okay, so we don't watch those things. So you help your clients keep from getting in a position where they are going to be in default, right? Plan, right? Plan ahead. Always plan ahead. To make a personal gain of some type, of course. Get richer. You also get promoted, get famous, right? Whatever. Okay, so it could be anything. Watch for people with motivation. Also watch for people with too big ego. If you're too important to talk to your auditor, you're scared. People who are too busy. I don't have time. You know what I do to clients who didn't have time? Finally, I'd sit outside their office and wait for them. And then I'd tell them, I'm billed you just for 2 hours sitting here waiting for you. Well, why didn't you leave and come back? Because this is the 4th time I've tried to schedule this meeting, and you're telling me I have to have the audit done on time. So it wastes a lot of money. Then they'll start talking to us. Or a client that just wants to get rid of you with some stupid answer, glib answer. You ask them a question and just throw something at them. Early in your career, it's going to have to be all the time. Some of them will just be jerking your chain because they used to be in your position, and they'll think you're cute and you're fun, and you come in and they'll tell you some bogus thing, have you go back and tell the senior their bogus answer, and the senior will get pissed about it because they're trying to get their work done, and then the senior will go back with you to the client, right? And and say, for God's sake, stop doing that, answer his question, and they'll both laugh and be in the fun. That stuff you can live with. But some of them will know that you're a rookie and you don't know what you're doing, and they'll give you ridiculous answers because they think you'll buy it, you'll write it down in the work papers. Don't take ridiculous answers. If you don't understand, apologize for being so stupid and so inexperienced, and ask again. If they can't explain it to you, it's probably because, well, two reasons. One is they don't want you to know. Two is they don't know. Either one of those is scary as hell. That you don't want me to know is real scary. But that you don't know what the transaction was, and you did it? Are you kidding me? You have to know what it is. If you can't explain it to me, you don't know what you're doing. Sorry. You're not smarter than me. You probably are smarter than me. But it's not proof you're smarter than me that you can't explain it to me. Explain it to me. I've seen a lot of stuff. Explain it to me. And I always apologize. Bring it down to my level. I'm kind of slow, I have trouble understanding, be patient with me. Explain it, explain it, explain it, explain it. Okay, so you can get yourself out of these situations by just paying attention. No, it's not okay. Right? It's not okay. Is it okay if they don't have an audit committee of the board of directors? Well, actually, you have to have one. Right? If you don't, your internal controls are inadequate. It's nice we have a little internal control report now, huh? Because they're automatically inadequate if you don't have one. The audit committee should be people who are not in management positions, right? Because the auditors report to the audit committee. They're independent of management. Management might be on the board of directors, but the audit committee is the subset of board of directors. They're people who are knowledgeable about finance and accounting, right? Not necessarily accountants, but they're knowledgeable. And then they work with the auditors, and the auditors explain to them the issues they're having with management, right? And report to them. You'll get all this stuff in audited classes. Weak or non-existent internal accounting controls. You don't have internal controls to do accounting. You have internal controls to have a profitable business. I want people to deliver to my customers what they ordered for the price that we agreed to. I want them to charge them the right prices. I want it to get there on time. I want it to be quality. I want everything to work. I want my employees to make sure that my customers pay on a timely basis in agreement with the terms, that they get the discount if they're entitled to it. If they don't, get it. Get the idea? That we buy from approved vendors, that we negotiate the right price. I want everybody that's working in my organization, if I were a CEO, to follow all the internal controls so that we make as much money as possible. And so that we keep our customers happy, which is how you make money. We keep our employees happy, we compensate them well, right? We treat them good, and we expect them to do a lot, and they deliver. It's running the business. So don't think about internal controls as things we do, and keep your clients and your employees from thinking internal controls are things that we do to make everybody's life difficult. They're not. They're things that we do so that we have a profit. Why do you want internal controls over accounting? Because you kind of like to know what the hell's going on. That's what accounting's for, right? I want to know what's happening. If we don't have good internal controls over accounting, guess what? We don't know what the balance sheet should say and what the income statement should say. We don't know what's going on in the business. How can you change anything if you don't know what happened? So accounting really does have a lot of value if you use it to what? Run the business. That's what it's for. Why are so many of you guys being accountants, become CPAs? Why are you going to end up running businesses? Either as a CFO, a CEO, maybe an operations manager. You're going to go in all kinds of different directions. Your own business. How come that happens? Because you know what's happening. You can measure it. You can monitor it. You can make changes and then see what the effect of it was. It's going to run right through those statements, you guys. It does all the time. Okay? I do it in my position here, believe it or not. Trust me, we're looking at revenues and expenses at Bellarmine. We got to pay for this building here. Right? How are we going to do that? Luckily, I don't have to do that. Somebody else has to go raise that money. It's not coming from your tuition. So anyway, sure. If transactions are huge, they're different. In Enron, they were going to all sorts of business lines they did not understand. Right? Oh yeah, that was no flag. Right? Accounting estimates requiring significant judgment, and they're big, they're material. What's really funny is at the end of audits, you sit down and you look at each other and you say, what did we miss? What are the big items? And you find you did all this work, hours and hours of work, and you've got 5 journal entries maybe that you're fighting with the client over. And the total of those journal entries, if they all go against the client, put them in a loss position, and if they all go in the client's position in their favor, they put them in a big gain position. You're sitting there saying, what should we do with these entries? That stuff's fun. How's all that? So, go away. And keep studying. And I guess we're going to go into Boyle now, huh? Chapter 8 in the new book. We'll find out if international is truly different than domestic. See you guys.